Great.
So old business, Hound Resources royalties.
So in your packet, there was a list of the royalties for the fiscal year ended June 30th. And you can see we got a rather big chunk in March and February, which were the arrearages. So they've been paying, they got all caught up and they've been paying current, so that's a really good thing. So,
That's awesome.
Seems like the communication is a little bit better with this company than with Aztec. So we'll just continue to monitor that and make sure that they continue to remit the payments.
Okay, approval of minutes from May 12th, 2023.
I'll make a motion to approve the minutes.
All in favor?
Support.
Aye.
Aye.
Opposed?
Aye.
Ed, did you give support?
Yes.
Okay, investment advisor update and commentary.
Bill? Yes. Sorry, I got stuck on a call.
All right, I think you're on.
Okay, Troy and I are happy to be here. Troy by Zoom, and what we'll do is follow the normal routine. We'll talk a little bit about market backdrop, the economic environment that we're dealing with. I'm on page 4 of the booklet, and it's probably good to say that we're kind of in what used to be called, and I haven't seen the term used more recently, but kind of a Goldilocks economy. Not too hot, not too cold, inflation moderating. It's kind of the perfect market, perfect environment for markets, particularly the stock market. You've got economic growth with declining inflation, and as you'll see in a moment, inflation is coming down to that sweet spot of 3%, might go lower. It's kind of really kind of unpredictable at this point. You know, a year ago we were looking at 9% inflation, and I think people were shocked it came down as fast as it did, and it's not something that I don't think many people have great deal of confidence that it will continue to stay low. It could. It's just there's lots of moving parts to the inflation picture globally, and right now it's very encouraging. So we have basically stocks are reasonable value. Bonds are now yielding some of the highest yields we've seen in 10 years. And the work of the Federal Reserve seems to be pretty successful. Of course, we still have these global political tensions, whether it's in China or Ukraine. But overall, inflation, as we say here in the conclusion, it's improving, but it's still problematic. Slowing economic growth, some potential issues out there, but generally everything is fairly encouraging. Troy, would you like to fill in or add anything to that?
No, I'll just mention that, you know, on the bond side, we've enjoyed these recent higher interest rates in terms of putting money to work. And on the horizon, you know, when we look out for the next 12 months, it looks like the Federal Reserve is giving us signals that they're going to probably keep interest rates pretty stable and high to fight this inflation problem until it gets even better. Oddly, the market is kind of predicting rate cuts next year. So I think on the horizon, when we look out 12 months, you know, the bond market is pricing in 5 rate cuts in 2024, kind of signaling that, you know, when we go back in history, the Federal Reserve tends to over-tighten or stay too long and eventually, you know, put the brakes on the economy. And so, you know, when we look into 2024, I think that'll be the big thing is, you know, have we gone too far with our tightening, and is the economy under too much pressure? And, you know, is the Federal Reserve really going to cut rates so aggressively next year? So that's kind of out there on the horizon. But for the time being, you know, as Woody said, you know, inflation's going in the right direction. These interest rates give us a lot of opportunities on the bond side, and I know stocks have reacted favorably because of this sort of good balance between, you know, where we are in terms of the economy. And so, yeah, I just I think we are in a good spot right now, but that doesn't mean it'll stay like that, right?
The next page, this entitled Higher Inflation Has Been Very Disruptive, is really a very remarkable chart because you think about in a 3-year period, we've gone from nearly deflation, which is negative inflation, to inflation that was running at an annualized rate of 9%, and now it's down to 3%. I mean, I don't know there's been a period in history where you've seen this kind of incredible change, and you can see it peaked last June at 9.1% on an annualized basis. This dark blue line is what the market, there are securities in the market, U.S. Treasury securities that predict what inflation will be over the long period of time, and those actually have been fairly steady. So the big smart money has been pretty accurate in estimating that inflation is going to be around somewhere between 2 and 3%. Right now, it's showing over the next 10 years that the market expects inflation to be about 2.22%. That's that there on that blue line on the far right. But it's really been an astounding 3-year period.
So Woody, the rapid increase and rapid decrease reminds me of the Lake Michigan water levels over the past 3 years. The real question is the Fed seemed really aggressive this time around in raising rates, which I think is warranted. Does that kind of give some credence to their approach this time rather than playing it slow and letting inflation get out of control? Or is that part of what's causing this steep decline this quickly?
I think so. I think it's probably been the Federal Reserve has been pretty aggressive and I guess you could say somewhat savvy, but I think luck plays a lot into it. There's factors that are beyond their control, supply chains, consumer behavior, business behavior, political issues, things like that. But I think it's some good luck and some aggressive moves by the Federal Reserve have combined. Troy is more of an expert on this sort of thing. How would you see that, Troy?
Well, clearly they waited a long time before they started to tighten, and people would argue that they let inflation get too far ahead. Possibly that was the savvy move that put enough support under the economy to tolerate these rate hikes. And so, they're taking inflation away, and thus far the economy is still running along fairly well. At the last GDP read was 2.4%, which is very good considering the tight environment we're in. And unemployment at 3.6, and July CPI it went up a little bit to 3.3, but it's still overall trending down. And so I agree with Woody. There's a little bit of luck, but also I think they waited a long time and then they brought both barrels at it, and now they're at a point where they can take their foot off the pedal a bit and let some of that work they've already done tightening do its job. So yeah.
Okay, well, let's see. The next page is this. It points out the very unusual tightening that the Federal Reserve has been through in what we call this cycle. When you have a tightening cycle, that means when the Federal Reserve, when inflation starts to increase to a level that's uncomfortable and the Federal Reserve wants to slow down the economy to reduce inflation, you start raising interest rates. And we have on here 5 of these periods of time, 87, 94, 83, 99, 2004, 2015. And you can see this has been the most aggressive that we've had in roughly, the last going on, 40 years, 50 years. And it just points to how the reaction of the Federal Reserve has been, very robust in terms of trying to fight inflation.
Woody, did they estimate how many more months for this cycle?
Troy, do you want to respond to that?
Well, as I mentioned earlier, the market and the Fed are expecting to cut rates next year. That's kind of out there in their long-term forecast. So that would mean another, 6 to 12 months maybe before they start cutting rates. Again, a lot has to happen before they start cutting rates. The economy is, it's not really struggling to the point where you'd say they need a lot of rate cuts. So, sometime between now and the first part of next year, the economy needs to slow and other problems may need to pop up before the Fed sees a reason to start cutting rates. So, that would be, my guess would be sometime early next year so far.
Next page is U.S. leading economic indicators. And as we've talked about in the past, this index of 10 indicators that are described at the bottom in that box, these have had a very reliable and accurate, it's been a very accurate forecasting device of when we're going to have a recession. That's why they call them leading economic indicators. And you can see these vertical gray bars that the blue line drops. Hey, Doug. The blue line drops before the recession, before the gray bar, and that's why it's a leading indicator. And you can see right now it's dropped pretty severely, which would indicate we're having a recession. But as Troy would tell you, this has been the most forecasted recession that has not occurred in recent history. We've been talking about a recession on the horizon now for going on year and a half, 2 years, and there's really no evidence of it, which is surprising. I think it has a lot to do with employment is very strong. Consumers have household income still from the pandemic, so they have a little money in the bank. Jobs are plentiful, and that's not going to get people to pull back like they have historically. So hopefully this indicator, this leading economic indicator, might be one of the first false signals, one of the few false signals that we've had. Let's skip ahead to maybe the last page in that section, page 10, which is something new, which kind of gives maybe a little education to the board here about how markets perform. And this page is called Time, Diversification, and Volatility of Returns. And you can see on the far left these one-year rolling returns. So if you go back to 1950, from the 72-year period, 50 to 22, that the stock market has ranged at an annual rate of return. The highest was 39%, the lowest was the highest was 47% in a 12-month period, and the lowest was a negative 39. And for bonds, it was a negative 13 to a positive 43. And if you had a 50-50 portfolio, which, it's a little off from what the oil and gas fund is, you're 65-35, but you would have had, the worst return would have been a negative 15 and the best 33. But then as you move along and you look at, let's say, a rolling 20-year period, so think about it, any period, let's say there would be around, I believe, 52 20-year periods. You think about 1950 to 70, 51 to 71, that kind of thing. And the worst return, or the worst return on a portfolio that was all stocks would be 6% per year for the stock market. The best would be 17% per year for 20 years. And then for the bonds, 1 and 12. So it's kind of an interesting way to look at things. We're coming up now, I think we've had about a 15-year, Ed, I think we're just coming up on, we just had the 15-year anniversary, or close to that, coming up on 15 years history with the oil and gas fund. Any questions so far? On tab 2, we'll get into the portfolio, and you can see the asset allocation on page 12. It's happy to see that the fund has crossed over $13 million on the end of July. We're pretty close to the targets. If you look on the far right-hand column, The investment policy statement of the Manistee Oil and Gas Fund is to have 65% in stocks, 30% in bonds or fixed income, and 5% in cash. And we're pretty close to that right now. We also have some money exposed to international equities. And then there's that internal loan, which is being kind of amortized down from what it was originally. On the next page, we have fixed income, and I'll turn that over to Troy.
Yes. So this represents the overall characteristics of the bond portion of the portfolio. The table in the upper right-hand corner, the one that always jumps out is the yield, and you can see there it's 4.97, a little better than the benchmark 4.81, and then the average maturity is very, mostly intermediate bonds, a little over 4 years on average, and the credit quality is A+ versus AA+. We just had the downgrade of the federal government. It's got 2 AA ratings now, and I think we're going to have to adjust a little bit that benchmark because there's a lot of Treasury notes in that benchmark. So we'll work on that. That probably won't change it much because it was a very small downgrade from AAA to AA+. Over to the left, you'll see the maturity distribution. We've got bonds for the portfolio in green. They mature regularly. We've got quite a bit maturing in the next year, which will be nice because as the lower coupons roll out of the portfolio, we're able to get coupons now of 4, 5, and maybe even 6 back into the portfolio. 1% and 2% coupons are leaving the portfolio, so it's very, very good on the horizon here for how we're repositioning the overall long-term health of the portfolio. Down in the lower left, you'll see there the sector distribution. We favor corporates the most. They're just a little less than 50%. But mortgages and agencies and treasuries also make up a good amount of the portfolio for diversification and safety. And those will be very handy to have in a recession, which we keep pushing back because it just hasn't rolled through here yet. But those will be good performers at some point. So far, the market on corporate bonds is not indicating recession. You tend to look at the difference in the yield between a corporate bond and a treasury note. That difference is not screaming any alarm signals. You're getting paid what is more of a historical average spread over a treasury yield. And so that's just one more indicator that we don't see a recession right on our front doorstep yet. Lower right corner there, you'll see the credit rating distribution. Again, the A's and the triple B's would be the corporate bonds pretty much in the portfolio. Nothing below triple B, that would be junk rated. Double A's and the triple A's and the governments, those are all the mortgages and the treasuries and the agency notes. So again, high quality portfolio is positioned for good, reliable income and provide good balance to the overall equity portfolio too. So anyhow, any questions on the bond portfolio?
Troy, what are we earning on our cash right now?
On the cash is about 5%.
Haven't had that in a while.
No, it's in a government money market fund at Schwab, and it's doing a great job. Yep.
The next page is how the stock portion of the portfolio is diversified, and you can see along the left-hand column are the 11 industry groups in the Standard & Poor's 500, starting with information technology, going down to real estate, and the looks like dark blue, or the darker line is the Manistee Oil and Gas Fund, and then the gray line is the Standard & Poor's 500. So you can see we're a little underweight in the technology sector. We're more overweight in the healthcare area. And that's because we are a little more defensively positioned. Our goal is to outperform in the difficult markets, and we typically underperform in the very strong markets. And so we have less exposure to what we would call the riskier sectors of the stock market. things like energy, technology, things like that. So that's how we're diversified. The next page is, the next 2 pages is the history of the cash flows of the fund, the distributions. You can see we started with 6.7 million in 2008, and then you can see the column for the oil and gas royalties, and then the distributions for the capital budget, and then we've had some special distributions. We've had 3 of those over the years, 2014, 16, and 19. And you go to that second page, you'll see we've had total distributions of about 6.5 million. And oil and gas royalties of about 1.1 million. It's great to see those pick up, by the way. So, just getting to the key part of the batting order here. The next page is the performance. You can see we're having a strong year. Year to date, 11.2%. The 1 year, 3 year, 5 year, and since inception, going back to March of 2009. Pretty pleased with most of the results. You can see over the last few years that because the stock market has been so strong, as you may recall I mentioned earlier, we tend to underperform a bit in strong markets, hopefully make that up in the declining markets, but relative to the blend for the 3-year period, we're a little bit under. We're still over for the 5-year period. If you look at Manistee blend is kind of like the benchmark for the policy statement. And then if you go up to the top, you can see how those compare.
Woody, what is the difference? I know what the words mean between gross and net, but what accounts for the difference?
That's the fee, the management fee to
That's what
Bartlett.
I thought it was.
Yes.
I just wanted clarification.
Yeah. So that comes out to around 0.5%.
Gotcha. That's what I thought, but I.
Are you done? I don't know.
Yeah, I'm done.
Okay.
Well, formally done, but
Okay.
here for questions.
I've got a question about China.
Yeah.
You see that in the news a lot. There's a lot of moving pieces there. It's a very dynamic relationship. A lot of businesses are by choice, or some are being forced to kind of pull back some of their investments in China and maybe relocate to different countries or back to the U.S. There's companies that are specifically trying to de-risk their exposure to China. Where do you see that kind of playing out, and what impacts do you think that might have on the portfolio?
Well, it's pretty clear from the data that the Chinese economy is very, I mean, the growth rate has really dwindled down to low single-digit number, which is really shocking from what we've had over the last 30 or so years. One of the risks to the getting inflation down is there's a trend going on which is called de-globalization, which was for most of the lifetimes of the people here in this room, more and more jobs were sent overseas, right? But a lot of them were going over to China, and now that's in reverse. People are now onshoring some of these jobs again. I mean, it's not huge, but the trend is definitely going back that way. And that deglobalizing was very disinflationary. It brought inflation down because costs were lower over there. I mean, you go to Walmart, you buy stuff, it was all made in China, right? And it's all low-price stuff. I mean, it's a good price, it's a good deal, but some of that is going to start changing, and they're shifting to other places, bring it back to the U.S. The other issue is China, for the last 20 or so years, has represented about, if you look at the growth of the total world economy, the growth, let's say the growth was 3.5%. China was half of that. So China was a big, big part of the overall world economic growth, and that is now kind of in question too. What's kind of surprising is the world seems to be doing just fine with China going through this kind of sort of like a recession, which we've never seen before. So it remains to be seen whether there's further implications of this China slowdown. But Troy, you may have some thoughts on that too, because I know you think about this a lot.
Yeah, I mean, the one for me is the notion that the Chinese government will nationalize companies that otherwise would have free trading stocks that you invest in, and suddenly you wake up and think, boy, I own part of this company, and now it's owned by the Chinese government suddenly. And so, to me, that's one of the risks that you keep an eye on is, how much of that will happen or has happened, and I mean, they kind of shoot themselves in the foot because that scares capital away from their economy. But I mean, I think that's a risk. They're not always driven by the same economic motivations that most developed countries are.
Yeah. And I think the other side to that is China has learned that these policies they've had have not worked very well. So they might actually need to kind of go in reverse and open things up a little more, and take the screws off businesses and have the government be less of a factor in the economy because the way they're going is they're getting less and less return from more and more government, which is probably a good sign for everybody, right?
Well, if we're onshoring or we're switching manufacturing from very low cost to less low cost, that's going to tend to want to keep inflation at a
Yeah.
higher level. So that's maybe the Fed ends up keeping their rates higher for longer. And I guess that's another question, Troy. If the economy's humming along at 5% Fed funds rate, let's say, and there's no sign of a recession, I mean, I would think the Fed wouldn't have any reason to lower rates because they want to keep their tools in their toolbox, right, in case there is a recession. I mean, how have we seen a period where we've had Fed fund rates at that a higher level for an extended period of time just because the economy kind of hits a sweet spot and it's not really being adversely affected either way?
Well, your first part of your question about the economy's humming along, and I'll just add to that. I mean, look what's going on with negotiations for wage contracts through UPS recently, and the automobile makers are on the horizon, and so there's a lot of strength in on the labor side right now, getting better contracts. And so, as Woody mentioned, the better those wages turn out to be, more likely the consumers are going to continue to spend and consume, and so that also keeps the economy humming along and keeps the Fed from feeling like they should lower interest rates. So that's another point that would cause the Fed to sit tight and as you said, Ed, keep their powder dry for when they really have a serious recession before they start lowering rates. In terms of looking back over periods of time when the Fed left rates high, I'd have to dig into that, Ed. I'm not sure I could throw that answer back at you.
I'm part of the reason I'm asking is I'm kind of trying to figure out what that means for the city's portfolio. I mean, we're enjoying some really great returns, on the short end of the yield curve, and just trying to kind of look out a little bit.
Yeah, for right now, I think you could make the case that, investing in short-term bonds is not a bad place to be, even money market funds. And we don't have any near-term evidence that the Fed should cut rates anytime soon, other than the bond market. We can look at the way the contracts are written for different bond instruments, and you can see the market is expecting the Fed to cut rates next year over 1.25%. So we're at 40 now. That brings it down to mid 4s or low 4s. Even if they did that, that's still not terrible in terms of where interest rates might land. But
Considering where
you
they've
know,
been.
yeah, I mean, we're over 5. That's pretty good if inflation's really going to be 3. That's a real interest rate that generally is causes you to like bond investments.
Does the Fed have a real interest rate target? I know they have an inflation target.
They would talk about it in terms of being neutral or balanced, which means close to 0, I think. Anytime they've got a real interest rate going on, I mean, that's kind of a sign that they're tight. They've got interest rates higher than inflation, meaning that, they're causing the economy to pay more for financing costs, which is sort of a drag on the economy. So, those tend to be periods of time that should favor bond returns over time.
Thank you.
I have an international question concerning Canada. With the Canadian fires, with so many thousands and thousands of acres, I don't know how much that is coming into the U.S., has come into the U.S. before as timber and paper products. I know, for example, Procter & Gamble, all of their products like tissue, toilet paper, that's all comes from virgin wood in Canada and is shipped down here and processed. So I'm just wondering if you're seeing any impact on the fires with those kind of commodities.
I have not seen any indication, and I don't think I haven't seen a material change in lumber prices, lumber contracts that would indicate that about 2 years ago, lumber, which went out through the roof, through home building, and the mills could not keep up with the demand for 2x4s and other kind of construction lumber. But I haven't seen anything yet, Linda, that would indicate that these fires are going to affect, lumber prices or pulp prices or anything like that. But that could happen. I don't think we've seen it yet. It may be that some of these fires might be coming from areas that are not typically harvested too.
That could be too. Geographically, I don't know which areas they're exactly coming from.
Yeah, good question.
Thanks.
Mayor, did you have a question? Oh.
Anybody else? Okay. We don't have any public, so no public comment, so motion to adjourn.
Motion.
Madam Chair, I'll apologize for being late. I was stuck in a dentist chair. And
You were what?
their X-rays machine wouldn't